Late nights, early mornings, he stays on the grind. Looking past the rate sheet for the value you'll find. He listens, he hustles, he speaks with intent. Every
Hey,
signature
good morning and happy Saturday, and welcome to What's Up with Real Estate. And well, let's just say historically, December and January, are slow months. But this past December didn't just slow down, it sort of dropped off a cliff. Pending home sales fell more than 9% from November to December, one of the sharpest months declines we've seen in many, many years. What makes that confusing, however, is mortgage rates were relatively stable during that time, sitting in the low six range. So today's show is about separating that data and what it says and what it doesn't say. Buyers and watching for moving forward. February and the coming spring market. All this and more news you can use for week ending January 23rd, 2026. I'm your host, Mortgage Mac. That's first name Mortgage, last name Mac. And you know what? We build relationships with real estate agents and the buyers to help everyone win, along with everyone's favorite co-host, ChatGPT 5.2, who is never late, never cancels, always on time, and offers extraordinary insight that I'm not sure that many people could offer. Say hi, Soul.
Hey everyone, glad to be here. We're going to dive into all these trends and make sense of what's really happening in the market. Let's do this.
Let's do it. Talking point number one. Doesn't sound like ChatGPT Soul had her coffee yet today. So while she gets coffee, I'm going to do the introduction to talking point number one. Well, let's just say that the president was at the World Economic Forum and said homes are built for people, not corporations, and referenced an executive order aimed at limiting large institutional investors from buying single family homes. Now, let's put this into its proper context. Large investors only own about 2 to 3% of single family homes nationally, and this is not a full ban. So, on paper, institutional ownership isn't the primary reason for housing unaffordability currently, but history matters. During COVID, when we had massive quantitative easing and extremely cheap money, we saw institutional capital move into the housing market aggressively. And even if they weren't buying the majority of the homes, they changed the market. Main Street buyers, families, families were suddenly competing against cash offers, waived contingencies, and buyers who weren't price sensitive the way families are. So that absolutely pushed higher prices much higher than they would have been otherwise in that point in real estate history. So, is limiting institutional ownership a bad idea? Objectively, no. If the rules are targeted, reasonable, and enforced properly, it can help reduce future distortions that we experienced during COVID. But here's the reality: even if you remove the institutional investor buyers entirely, we would still have an affordability problem for one reason. So, do you want to chime in here and share with us what that reason is?
Absolutely, Mac. The core reason is supply. We just haven't built enough homes to meet demand. So even if we curb institutional buying, we still need more housing development to truly tackle affordability.
Yeah, and that supply goes all the way back to the Great Recession. So we're still living in the historical context of the Great Recession. And what caused the Great Recession, ChatGPT? Care to elaborate?
Well, the Great Recession was largely triggered by the housing bubble, fueled by risky lending and subprime mortgages.
Fueled
When
by deregulation. Would you agree with that? Could the Graham-Leach Act give us sort of a history lesson on the specific regulatory actions taken during the 90s that more or less repealed what we've just read about in 1929, the Glass-Steagall Act?
Absolutely. The Glass-Steagall Act of 1933 separated commercial banking from investment banking to avoid conflicts. In 1999, the Graham-Leach-Bliley Act repealed those barriers, letting banks merge activities. That deregulation contributed to more complex, riskier financial products, playing a role in the eventual housing crisis.
Yeah, and the key is supply. The real issue is inventory, and we simply haven't built enough homes for decades. So that's also why the Houston market behaves differently. We build more. We build a lot. We probably build more than any other city in the United States. Can you give me some context for that statement, please, ChatGPT?
Absolutely. Houston consistently leads the nation in housing starts. The region's looser zoning and ample land have fueled high construction rates, which helps keep prices more manageable,
Yeah,
though still not immune to broader supply issues.
yeah. So banning investors without building homes is like banning umbrellas instead of fixing your roof. Now, let's move on to talking point number two. And you know what? Wow, we talked about this in the intro. One of the surprising data points we saw recently, or as this past week, was a 9.3% drop in pending home sales from November to December. On the surface, hey, that could be alarming, and it should at least get our attention. Now, to be fair, December and January are typically the slowest months of the year for housing activity. I can tell you that when I first got in the business eons ago, December, January, I kept 3 jobs. So, but seasonal slowdowns are normal, but what makes this difference is the size of the decline, a drop that isn't something we see every year in December, at least not so dramatically. So we have to ask, is this a warning sign or is this data distortion? And here's where context matter. Mortgage rates didn't spike during that period. They stayed in the low 6% range. And coming into January, at least in my own business, things seem to still be rather modest as far as activity is concerned. And here's something I think is critically important that we must remember. People borrow money, and unless you can pay cash for a house, you have to borrow money. They borrow money because they believe the future is going to be better than the present. And when buyers stop believing that, transactions stop. So this isn't just about rates or seasonality, it's also about confidence in the future. So, what does this data tell you about housing psychology right now?
It tells me that sentiment is fragile. Even stable rates can't overcome uncertainty. If buyers doubt the future, they hesitate. So, beyond just rates or supply, we need broader economic and social stability for real confidence to
No
return.
doubt, no doubt. And look, I'm not sure we have the leadership to bring either one of those. And I think it's consistent with what, we just read the book 1929. The stock market fell off, and that's what everyone remembers. We all celebrate Wall Street. But Wall Street is not the economy. And stock market is not the economy on Main Street. Only 10% of the um, population, the highest 10% of income earners own 87% of the stock. I mean, my people that are buying their first home usually don't own stock outside of their 401k. And and what we saw during the Great Depression, leading up to the Great Depression, was not deregulation, but the lack of enforcement of proposed regulation. Now, here's what happened though, is it took 2 years to have a full impact on Main Street. But when it did impact Main Street, unemployment rates were 23%, soup lines were out the window. So, do I believe that we're going to have another instance such as that? I think the answer should be a no, right? At least if we have reasonable leadership and in control and independent controls as it relates to currency policy. Because if you look at the Great Recession, you look at the COVID, you know, off the gold standard, we can print money. And that's what the Federal Reserve did. And we managed to get through those events without the same type of soup limes. ChatGPT, do you have any comment before we move on to the next, before we move on to a commercial break for this point that I'm making, please?
I'd just add that thoughtful regulation, balanced monetary policy, and maintaining public confidence are key. We have more tools now, but it's always about ensuring people trust the system and see a stable future ahead. Let's keep that in mind.
And having wise leaders. I believe that's really, really critical. And let's be honest, December data has a habit of ruining moods right after the holidays. And now for a break from rate.
A well timed break in.
Looking to purchase a new home? The Rate app from Guaranteed Rate has got you covered. Once you've downloaded the Rate app, click to log in and create your password. This will take you to the intro page. Click the gray Same Day or Home Loans tile, and then click the red Apply Now button. Then click Start a New Loan. Begin by telling us where you are in the home buying process. Typically, for a pre-approval, you will click What Can I Afford? From there, the Rate app will load a series of simple questions. Answer each one the best you can as you move along. Once you've completed the application, your loan officer will receive a notification so they can review your information and set up your personalized checklist. The Rate app even allows you to upload documents right from your phone. It's just that easy. And if you do get stuck or have any questions, just give us a call. We'll be sure to get your questions answered so we can get you one step closer to owning the home of your dreams. The Rate app from Guaranteed Rate, simplifying life's biggest purchase.
Hey, if you don't have the Rate app on your cell phone, go to www.mortgagemac.com, download our Rate app. It is the best mobile application in the mortgage industry. Not even close. There's nothing not even close. So I can tell you that with confidence, having moving into my 5th year at Rate, best mortgage company on the planet. So moving to talking point number 3, mortgage rates held pretty steady. This week, the 10-year Treasury moved above the 4.25 mark, influenced by rising Japanese bond yields. I'm not sure that's relevant to locally, but we're going to get into that. But mortgage rates followed and stayed rather steady. The Fed is not expected to change rates on the January 28th meeting. And Houston buyers historically tolerate slightly higher rates due to lower price points. Payment sensitivity matters more than headlines. So, what matters to buyers right now? Rate directions or rate stability? What can you offer us in relations to that question, please?
It's really about stability. Buyers can plan if they know what to expect. Even if rates aren't perfect, consistent, predictable rates help buyers feel confident in making decisions.
Yeah, I agree. Stability does beat volatility. And when rates stay around that 6% mark, hey, when you're out there and you're shopping for a home, and we have folks out there shopping for homes, and, rates are rising when they're shopping, it can be extraordinarily stressful. Extraordinarily stressful. So we believe that rate stability certainly outpaces that. And look, hey, people were buying homes when rates were 18%, and it's really, truly all about payments. And well, let's just say the Fed isn't cutting, hiking, or panicking. And frankly, that in and of itself is good news. Okay, now moving on to this week's mortgage tip. And we're trying to keep the show under 20 minutes now, maybe even 15 minutes moving forward into the future. And my wife's going to the grocery store. Good for me. So this week's mortgage tip is, house hunting can feel like swiping on a dating app. Lots of excitement, lots of hope, and then you find the one and realize completely out of your league. That moment, that's what happens when buyers skip pre-approval. And today I want to simplify something for you. The industry has made way more complicated. And if this helps, do me a favor. Hit like, subscribe, or share this with someone who's thinking about buying a home. Pre-approval isn't just about the paperwork. It's sort of a formality, right? It's your house hunting superpower. A real pre-approval means a lender has reviewed, and I want to underscore this, not just the lender, but the lender's underwriter has reviewed your credit, your income, and your assets, and then given us a very clear picture of your buying power. That does really, really mean a lot. It narrows your search. You stop wasting time on homes that don't fit. It keeps emotions in check. Not falling in love with houses your budget can't afford, and it makes you competitive when you go out there and you're ready to make an offer. We help our buyers develop a pre-approval position so that we can go out, be aggressive when we make an offer, be aggressive when we negotiate. And this matters, especially in Houston, Sugar Land, maybe even places like Katy where homes, they go under contract in days, and sellers don't want maybes. And I believe there's a time coming where eventually real estate agents will begin to recognize that, hey, this is just a pre-qualification letter and it's not an approval letter. Because in the state of Texas, we use 2 forms. We've used Form A, Form B, qualification, approval. And Both have a very distinctive message that they are intended to communicate on behalf of the lender and the buyer to all parties involved in the transaction to create clarity, to bring confidence to everyone that the buyer has done their financial due diligence. And definitely, if you're competing against someone else in the marketplace that has just a pre-qualification letter, I assure you that pre-approval is always going to be the winning ticket. So if you're serious about buying a home this year, pre-approval is the line between dreaming and doing. And if you found this helpful, like, subscribe, and share it. And if you're ready to turn a house hunting into home buying, reach out and let's get a pre-approval for you and your family. Okay, so you know what? Real estate can be extraordinarily stressful. And every week we like to stop and take a step back and take in some stoic wisdom to help guide us on a daily basis so that we stay centered in what really, really matters. And I can tell you, I experience this regularly as somebody that deals with the public. And I can tell you, I've experienced this as a human being, right? If it's impossible for a man to learn what he thinks he already knows. And I got to tell you, and later in life, in my 50s, I began to realize that, you know what, I just really didn't know as much as I thought I did, and I truly was ignorant about a lot of things. And I began to study history, began to study philosophy, economics, religion, and I really endeavored to bring out the why I believe what I believe, and can I objectively and rationally conclude that it is true. And so, so can you kind of maybe give us a little background on Epictetus and who he was, and maybe how this might be applicable in today's real estate market and life in general?
Epictetus was a Stoic philosopher who taught that we should focus on what we can control, our judgments and actions. In real estate and life, that means staying humble, learning continuously, and making decisions based on what's real, not assumptions. That mindset helps in negotiations, relationships, and knowing there's always more to learn.
That's right. Like that. Moving on. So, hey, we're going to no more charts, no more news, just some good old clean but questionable humor. So let's start with our first Stoic quote of the day. And we have List Reports to thank for this. And if you don't have a List Reports account, contact us. You get free content every single day that you can use on every single platform out there. I use the content for this show. I use it for TikTok. I use it for Instagram. I use it for YouTube. I use it for everything. Facebook. So first Stoic or fun with pun. Decathlon. Going a whole day without coffee. I like this one. Dijon vu. Having the same mustard again. And ChatGPT, you want to take over this one? Compromise is what?
Compromise is, well, an agreement where both sides are equally unsatisfied, but at least you've got matching mustard.
What you're saying is it's where nobody gets what they want.
Exactly.
Yeah.
But hey, sometimes in real estate or mustard, that's how you find balance.
That's right. But hey, I'm going to bring this one in. This was this morning's time for our TikTok channel. And if you have not gone to our TikTok channel and liked our TikTok channel, please do. And let's play this video one more time.
I'm all ears, Mac.
Music.
Loud and clear, Mac. I'm right here with you, ready to wrap it up whenever you are.
So, what do you call someone who mails their mortgage payment? ChatGPT?
I'm guessing a Lone Ranger, because they're out there tackling that mortgage one payment at a time.
Stumped it today. How about Post Malone?
Oh, that's good. Poached alone. I'll have to remember that one. A pun worth every penny.
Hey, and drop your favorite bad definition and the comments or bad puns in the comments. And hey, if you know me, bad puns, that's how I roll. So thanks for joining us for this week's episode of What's Up with Real Estate. Thanks to our sponsors, Rate, List Reports, and please subscribe, follow, and share this episode. And if you want a plan and not a pitch, book a time with Team Mortgage Mac. And remember, knowledge is the key to making the best decisions for you and your clients. Join us here every Saturday at 10 a.m. on LinkedIn and Facebook. And until next time, stay informed, stay engaged, and I'll see you at closing.